Your conference is being recorded.
Good evening, ladies and gentlemen. I am Hanila, moderator of Indian Railway Finance Corporation Q1 FY23 earnings conference call hosted by DAM Capital Advisors Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone telephone. Please note this conference is recorded. I now like to hand over the floor to Mr. Vivek Singh from DAM Capital Advisors. Thank you, and over to you, sir.
Thank you, Anila. Good afternoon, everyone. We, on behalf of DAM Capital, would like to welcome the management of Indian Railway Finance Corporation. Today, we have with us Mr. Amitabh Banerjee, Chairman and MD, along with Director of Finance and other members of the management team. We will have opening remarks from CMD and then move on to the Q&A. Thank you, and over to you, sir.
Yeah, good afternoon, everyone. I would, at the outset, thank DAM Capital for having organized this investors call. And good afternoon, my dear investors. We have had an organic growth in the Q1 of FY23. I'll be just running you through the presentation that has already been circulated to you all. If you go to the first slide, you see that it displays the key strengths of IRFC. So IRFC happens to be the dedicated market borrowing arm of Indian Railways. We are the sole borrowing arm of Ministry of Railways, and whenever Ministry of Railways has to take recourse to extra budgetary financing, then IRFC is the only source through which the Ministry of Railways draws the funds for financing its infrastructure requirements, which is not financed out of the government budgetary support. And the AUM of IRFC has grown at 15.13% in Q1 year on year, and it now stands at 4,32,474 crore. I would just like to mention here that AUM-wise, IRFC has become the largest NBFC in the public sector domain as on 31st of March 2022. Another thing is that we have always been having a strategic relationship with the Ministry of Railways with a very low risk profile. We have a cost plus standard lease agreement, and we have been always charging a consistent spread on our weighted average cost of funding year after year from Ministry of Railways. And it's a low risk cost plus business model, and we have never had any NPA in our books in our 36 years of existence. The firm is also characterized by very competitive cost of borrowing, backed by a highest credit rating from the domestic credit rating agencies like ICRA, CARE, and CRISIL. And we are rated at par with that of the sovereign in the international market. We have diversified funding sources with varying maturities and currencies, and we keep the cost of borrowing at a very low level due to this diversified borrowing sources. We have a strong asset liability management in place in the organization. For any NBFC, I think the ALM happens to be the topmost priority of any NBFC, that we should have a very balanced asset liability management. And we borrow on a long-term basis, and that is in sync with the tenure of the assets that we are financing of Indian Railways. And as one of the covenants of the lease agreement, the Ministry of Railways also undertakes to provide any shortfall that IRFC might face at the time of repayment of its loan or liquidation of its bond. If IRFC happens to be short of liquidity, then Ministry of Railways undertakes to fill up that gap well in advance, so that at no point of time, theoretically speaking, at no point of time, IRFC stands to default at the time of repayment. Although in our in these 36 years of our existence, we have never had this occasion to invoke this clause of the standard lease agreement. Nevertheless, this serves as a comfort for the creditors of IRFC. The net worth as on 30th of June 2022 stands at 42,657 crores, and the revenue from operations during this quarter has grown at 22.83% year on year, and the profit during this quarter has also grown at 10.63% year on year. We are characterized by very low overheads at only 0.1% of the total revenue, and very low administrative costs with a very high operational efficiency. We have a healthy return ratio at return on assets at 1.59% and return on net worth at about 14.4% annualized. And we are also exempted from various guidelines of RBI, like asset classification norms, provisioning norms, exposure norms, because more than 98% of our AUM is direct exposure to the Minister of Railways, that is to the sovereign, and therefore we have been given this dispensation from the RBI regulation. And we are also not required to pay any tax as our net taxable income falls below zero because of the existence of...
I'm sorry to interrupt, sir. Your voice is a little low, sir. I'm sorry to interrupt.
I'm so sorry. So we are exempt from... We are liable to pay tax as per the corporate tax.
This call is now being recorded.
Yeah, am I audible right now?
Yes, sir, you are.
Yes. So we don't pay any tax because of the existence of the unabsorbed depreciation in our books of account, and that makes our taxable income at zero or below zero level. You see, if you look at the next slide, you'll see that the total penetration of Indian Railways in our country is pretty low at about only 50 route kilometer per million population, as against 592 in Russia or 464 in USA, which shows that there is a great scope for capacity augmentation of Indian Railways in the years to come. And the IRFC funding to MOR has also been on the rise since FY18. It took a small dip in the last financial year as because of the better GST collections, the government budgetary support for supporting the railway infrastructure requirements was that much higher as compared to the earlier years during the COVID years, and therefore the recourse of Indian Railways to extra budgetary financing was kept at a lower level. But still, it was 31.4% of the total capex expenditure of Ministry of Railways that was catered to by IRFC. If you look at the next slide, the asset under management, as I said earlier, is 4,32,473 crores as on 30th of June 2022. The disbursements this quarter is almost 6,000 crores as against 8,056 crores in the last quarter, in the first quarter of the last financial year. About 98.62% of our AUM is directly to the sovereign, and the rest 1.38% is to our VNL and IRCON put together. Those are the other SPVs of Ministry of Railways, which are the PSUs of Ministry of Railways. We have been charging a consistent spread on both the rolling stock as well as the project loans that we have been giving to Ministry of Railways, that IRFC has been giving to Ministry of Railways, which stands at 40 bits in case of rolling stock lease and 35 bits, that is 0.35%, on the project asset financing. The borrowing mix as on 30th of June 2022 reflects that the major portion of our borrowing is accounted for by the bonds, which accounts for 44% of the total borrowing portfolio, closely followed by term loan at 33.54%, and then it is followed by the external commercial borrowing, which stands at 17.33% as on 30th of June 2022. We have given a comparative chart with respect to the first quarter of the last financial year also. And as you can see, the percentage of bonds has come down from 47 to 44%, and the term loans has that increased from 27 to 33%. We have been having a consistent financial performance over the years. The net interest income in Q1 stands at 1,687 crores as against 1,507 crores last quarter, and the profit after tax has registered an increase of more than 10% from 1,501 crore to 1,651 crore in the current quarter. The operating expenses are also pretty negligible, as I said. It is only 0.10% of our total revenue. The return ratios, if you see in the next slide, the return on asset is 1.59%, as I said earlier, and return on equity is 14.4% annualized. And the capital adequacy ratio has now crept up to 500% in this quarter, with a gearing ratio of 9.09, which is within 10 that we have always been maintaining. The net interest margin is about 1.55%. If you look at the key ratios, the NIM is at 1.55, return on equity is 14.4, net gearing 9.09, and EPS is annualized as 5.09. The revenue from operations in the first quarter has grown by 22.83% year on year as compared to the first quarter of the last financial year. And the net interest income has also registered a growth of about 12%. Profit before tax has grown at 10.63%. And that brings us to the end of the presentation. And as you can see, if you look at the financials, the balance sheet and the profit and loss account, we have the balance sheet size to end of first quarter has surpassed 4,50,000 crores. So it now stands at 4,50,986.44 crores. So that brings us to the end of the presentation. We are open to questions, if any. The field is all yours. Thank you very much.
Thank you, sir. Ladies and gentlemen, we will now begin the question and answer session. If you have a question, please press star and 1 on your telephone keypad and wait for your turn to ask the question. If you would like to withdraw your request, you may do so by pressing star and 1 again. Ladies and gentlemen, if you have a question, please press star and 1 on your telephone keypad. The first question comes from Rajiv Malhotra, Iskanta Investments. Please go ahead.
Hi, this is an interesting set of numbers. Thank you for the presentation. The question is regarding the spreads charged by IRFC on rolling stock and project assets. They seem to be consistently different as 0.4 and 0.35. So is that as per an agreement with the government of India or something? That's my question number one.
Yes, that is.
Okay. So it's an agreement? So
Hello?
the question is that an agreement with the government?
Yeah,
of
it's
India?
a part. You see, every year we enter into a standard lease agreement with Ministry of Railways, and this rate is decided upon in course of that agreement.
So that means, taking on from this point, that every year we enter into an agreement with the government of India, that means that if there is any variation in our cost of borrowing year to year, that will be taken care of by this spread. Am I correct?
No, it's not like that. What we do is, the spread is consistent, and the weighted average cost of borrowing, that would obviously differ from year to year. But the variation in the weighted average cost is not taken care of by this. This is cost plus model. So whatever is the weighted average cost, we add 0.4% in case of rolling stock and 4.35% in case of project assets.
So this would be sort of an annual exercise. So that means that our interest, what we earn, will always be adjusted by that method.
Yeah.
Correct. Okay. So my second question is that how much is the carry forward unabsorbed depreciation which we are assuming is because of the leased assets to the railways?
Yeah, I think it should be around 7 to 7,500 crore right now.
7 to 7,500 crore. Okay. Thank you. Thank you for your answers.
Thank you.
Thank you, sir. The next question comes from Ralston, an individual investor. Please go ahead.
Yeah, the question was more related to the interest rates going up globally. How does that impact the overall borrowing plans from the Indian Railways?
You're not audible
Sorry,
properly. If you can just...
Yeah, you're not audible, sir. Can you have your mic?
Is it better now?
Yeah, better.
Yeah, it's better now.
Yeah, so what I was interested in knowing is about the interest rates going up globally. How does that impact the overall borrowing plans from the Indian Railways for its rolling stock requirements and expansion?
You see, as I said earlier, IRFC has been taking recourse to very diversified sources of borrowing. We borrow through the bond market, domestic bond market, the 54 UP bonds, that the capital gains tax exemption bonds, and we also take recourse to domestic loans from the financial institutions. We take recourse to external commercial borrowings by way of this 144A as well as Vegas bonds in the US and the European market and the Asian markets, as well as we take syndicated loans from various multilateral funding agencies. So we have a very wide source of funding. And as I said, if you would have seen in the last year, when I was in course of my presentation, I said that the total proportion of the bond portfolio has reduced in 21-22 as compared to 2021. So if you can see in Q1, for instance, Q1 of FY23 and Q1 of FY22, if you see, the bond holding has gone down from 47 to 44, and the term loans has increased from 27 to 35%. That's primarily because of the fact that you would be recollecting that the bond market last year was very pretty tight. So therefore, we took more recourse to the term lending institutions, the banks, and we got very good rates, very competitive rates from the banks as compared to the rates prevalent in the bond market. So we gauge the market at the time of going to the market. We gauge the market. We have got our teams which goes through the various sources of financing, and whatever is the best source at any point of time, we take recourse to that source of funding to keep the cost at a very competitive level. We approach the external commercial borrowing market also at a very opportune time when the rates are pretty competitive. So last time also when we went to the ECB, when we went for the $500 million green bonds, at that point of time, it was just before the US Treasury rate was increased. So we got a very competitive rate, taking into account the timing factor. So, and also buffeted by the fact that since we are perceived to be a quasi-sovereign entity as far as our rating goes, besides the fact that we are rated at par with the sovereign in the international market and we are getting the highest credit rating in the domestic market, we are also perceived as almost like a sovereign, because all our receivables, the entire revenue is totally guaranteed by government through budgetary provision. So there is a line item in the budget which specifically denotes what is the lease payable by Minister of Railways to IRFC. So that gives the kind of comfort to the investors and to the creditors, while advancing loans. So that is the reason that we are able to leverage the market to our advantage and we are able to get the money at very competitive cost.
So, sir, my question was more with respect to, not the ability of IRFC to, get the borrowing at the lowest interest rates, but more about, the plans of Indian Railways as such. Because I remember somewhere reading in the, on the internet that in 2007-2008, when the interest rates had doubled from 5.75 to 11%, at that point of time, they had halted the overall borrowing, the Indian Railways, and they had looked at some public-private partnerships for the overall, plans in their expansions. So just wanted your thoughts whether the overall borrowing plan of Indian Railways as such will reduce, which in turn will mean that it will request less amount of request to IRFC.
Well, you see, as far as the funding of the infrastructure requirement of Indian Railways, that is pretty substantial, and it forms a major portion of the national infrastructure pipeline of the government of India. It forms a very, very, substantial portion of the 111 trillion rupees NIP that we have for government of India, and therefore, you see, as far as the thrust on PPP is concerned, that is very much there on cards, but that itself will not really be adequate to fund the burgeoning requirements of Indian Railways as far as their capex requirement is concerned. So it's not that the PPP is actually substituting the requirement, the EBR requirement of Indian Railways. But of course, I mean, there are various ways that Indian Railways looks at to augment their the revenue potential, the non-fare revenue, the non-fare box revenue, both by way of this monetization of assets, as well as through a public-private partnership with various the private organizations, as well as there are some SPVs which have been created by Minister of Railways in association with various state governments for creation of infrastructure in various states, railway infrastructure in various states. So there are various ways that definitely Indian Railways has for fructifying its efforts at augmenting the carrying capacity of Indian Railways. But as far as the funding requirements are concerned, basic funding requirements are met through the government budgetary support and the extra budgetary resource requirement that is catered to by IRFC.
Okay, thanks. And my last question, sir, was with regards to the, last time when you had mentioned that you were talking to large funds overall in the investment in IRFC. Any update that you would want to share with individual investors like me about any large investments coming up in IRFC, or for that matter, reducing the overall plans of the IRFC stake to bring it below 75%? If you can just share some light on that.
No, as far as I don't know what exactly your question is, because it seems to be a mix. You said that as far as the investments of IRFC are concerned, I mean, we are basically into, we are basically into raising money for the infrastructure requirements of Indian Railways. That is one portion. We don't have the investment is totally in Indian Railways. I mean, almost more than 98% is in Indian Railways, and there are some PSUs that we are lending to. But as far as the dilution
was more
of
related to the stock price. The stock price. Last time you had spoken that you were in talks with some large institutional investors about making a case for them.
Yes, we have. That is not. It is not a one-time kind of a thing. We are regularly, interacting with the investors, with the potential investors as well as the existing investors, and they have been coming to our office also. They have been confabulating with us. we also go to the investors and we talk to them. And that kind of an engagement is an ongoing engagement. It is regularly going on. But yes, there are certain issues as far as the share price is concerned. Share price is not merely, it's very difficult to really gauge what drives the share price. It is you see, the results are for you to see. The results are pretty robust as far as the IRFC is concerned. In the last 3-4 years, the CAGR has been hovering around 20% in almost all the financial parameters. So results are robust, but yes, it is the perception of the market that drives the share price. But we have been engaging with with various investors, with the investor community in general, and all our officers are going. Even I have been on my feet and I have been interacting personally with many major investors, and we have been, and they are also pretty positive as far as this particular thing is organization is concerned. So on that there is no issue. As far as the further dilution is concerned, below 86%, we are now government is holding 86% of the total equity portfolio. So as far as this financial year is concerned, 22-23, I think we don't feel the need for further capitalization this year, because our leveraging ratio will be well within 10, keeping in view the funding requirement of Ministry of Railways in this FY23, which stands at 66,500 crore right now. So but yes, as per the SEBI guidelines, we have to go up to 75% to end of FY24. So yeah, but as far as this financial year is concerned, we don't really feel the need, because anyway you will see that we are having a very substantial proportion of our net worth in the form of equity share capital. It's about 13,068 crores out of 42,000 crores. So we don't want to further, in this particular year, we will not require to go for further. As of now, there is no such plan. We don't know how the year transpires. But yes, now we don't have any.
Thank you, sir.
Thank you, sir. Participants are requested to ask 2 questions in the initial round and may join the queue for more questions. We have a question from Santosh Keshri from Keshri Wealth. Please go ahead.
Am I audible?
Yeah, please go ahead.
Yeah. Congratulations for such a good set of numbers. I have 2 questions. One is about the EPS that you disclosed in the slide number 9 of the presentation, where we were talking about.
Can you be a bit louder?
Yeah.
Yeah.
Okay. So first question is about EPS that is disclosed in slide number 9 of the presentation, where we are saying that EPS is 5.09. So my question was that is this the quarterly EPS that is analyzed by multiplying it by 4, or this is trailing 12 months EPS? That is my first question. How are you arriving at this EPS?
I think it is the annualized one by multiplying by 4. Yes, this is the annualized one. Correct me if I am wrong, Sunil.
Yes, sir. It is multiplied by 4, sir.
Right.
Okay.
Next question.
So then, are you projecting that there will not be any growth compared to the EPS that we have in the current quarter?
No, not really. This is just an extrapolation as far as Q1 is concerned. That's all. So generally, the Q1 numbers are always on the lower side as compared to the other quarterly numbers, and it picks up in course of the year. So definitely it will move up.
Okay. So does it mean that like 30% dividend that is to be declared by a PSU as per the government norms? So we can expect a dividend of something like 1.5 rupees?
Yes. I mean, the dividend this year would be about 1.4. What is the dividend that we have? 1.4.
For FY21-22, we have declared 1.4, and we can expect 10% growth in the dividend payment going forward.
For FY23.
Okay, that's great. So, sir, my second question was about the presentation in slide number 10, where we are saying the revenue from operation has gone up by 22% and finance cost has gone up by 28%. I just wondered that when we are a cost plus entity, we are charging 40 bits and 35 bits on two streams of revenue. Why should not be the profit also be going in the same proportion as we have the revenue? Because finance cost going up by so much means that we are under recovering or our cost of financing more than what we are able to recover from MOR.
Yeah.
Is my reading correct on this?
Yeah. Yes, Sunil may like to respond.
So basically, on the revenue side, we have two types of streams. One is the pre-disbursement interest income, and another is the lease rentals. Basically, in the pre-lease disbursement income, we are just booking the margin on the borrowed fund and the entire cost of borrowing plus margin on the funding through loan source. And whatever the lease rentals we are receiving from the MOR, the revenue portion of that is being booked as a lease income in the P&L. So basically, we are in the process of signing the agreement for our project funding assets also. So as basically, since in case of a advance, till the time it is advanced, we are just booking only the margin portion as an income in our top line. But as soon as we sign the agreement, then the lease rental start flowing to IRFC, and accordingly the top line. In the top line, we are the entire revenue portion. The entire revenue portion of the lease rental is going into the top line, and in similar fashion, we are booking the whatever the expenditure we are incurring on that account. We are booking as a finance cost. So this is a mismatch because of the movement of the one act to another act.
So it is primarily because of the fact. Let me just chip in here. You see, the point is that you have this kind of an apparent mismatch only because of the difference in the assets that we have. As far as the lease rentals from the rolling stock assets are concerned, there is no moratorium period. So the lease rentals start flowing in from the very next year. Whereas in case of project assets, which actually has surpassed the rolling stock assets as of now, it's more than 210,000 crores as against 2 lakh crores in case of rolling stock assets. There is a moratorium period of 5 years, during which the lease we don't get the lease payments, and that is why the recognition of there is a variation in the recognition of revenue between that of rolling stock as well as project assets. That's why there is an apparent mismatch. Just to put it succinctly, that is why there is an apparent mismatch. Otherwise, as you're rightly saying, it should be growing in sync with the growth in the project cost, the revenue. It is actually growing in that way, but because of the difference in the recognition of revenue, there's this apparent mismatch is there.
Yeah. So, sir, then looks like it's a little bit complicated, and IRFC being such a unique NBFC, like there is nothing like it in the whole of Indian economy. So, if a simplified presentation can be given, like what is your assets under project management, what is and the different categories that you spoke about, so that we can the analyst and investor community can see that how the 40 bits is reconciling with the profit that is being disclosed. It is really helpful, sir.
Yeah, we get your point. You see, as far as this revenue from operations or finance cost is concerned, these have been taken from the financial statements, which are in accordance with the Ind AS. So we can't. So what you are rightly mentioning is that we can give you an offline kind of a management information where you can directly see that. That of course can be given. But all these figures are as per the profit and loss account and balance sheet, basically, all these ratios and all these parameters that we have given. So we can't deviate from the the accounting standard requirements. So the recognition of revenue has to be accordingly tailored that way. But your point makes sense that for your benefit, for the benefit of the normal investor, we can give an offline kind of an information.
Right, sir. That will be very helpful. That will be very helpful.
Thank you. Yeah. We do.
Thank you, sir. The next question comes from Shailendra Mundra from Vibha Financials. Please go ahead.
Hello. So,
yes.
Good evening, everybody. So, congratulations for achieving a good set of numbers and a very good growth in the company over the last few years. So, I'm a new investor post the IPO I invested recently. I'm trying to understand the leasing part of your operation. So I just learned that there's a moratorium of 5 years, and could you please explain to me the business model? So you say that you have a 0.4 or 0.35% spread over lending. So how does that apply in a leasing business where the value of the asset is depreciating every year?
Right. Okay. Please, GGM, please elaborate on that.
Basically, for funding of this project asset, we are following a financing model where we have to fund as per the requirement of the MOR. And in that way, as per the MOU signed with the MOR, we generally follow a moratorium period of 5 years. After this completion of 5 years, we'll execute a lease agreement with the MOR. Whatever our cost of borrowing, we'll add 30 bps over it, and based on that IRR, we'll determine the lease rentals which are going to be paid by the MOR during the next 15 years. So basically, it's like a cost plus model. So during this period of 5 years, we are recognizing whatever margin we are getting on this funding as our top line. And once we sign the lease agreement, so we will, with whatever rental we are receiving against these assets from the MOR, the revenue portion, which is based on the my cost of borrowing plus this margin, I am recognizing in the P&L as a top line. I think I have answered your question.
No, I have not understood.
I'll just like to add one thing, very important thing.
Yeah.
That what you talked about the business model.
Yes.
Now you see the business model is very interesting as far as IRFC and Minister of Railways is concerned. The business model is like this. There is something called allocation of business rules in Government of India. You see, you might be wondering that why don't we directly give loans to Minister of Railways, and from that loan they can directly buy the assets, and where is the question of then the question of leasing will not arise. It will be a simple lending business. You see, as per allocation of business rules, as per that, no ministry or no department of Government of India other than Ministry of Finance can directly raise loans from the market. So by that reason, even Ministry of Railways cannot directly take loans from IRFC.
Okay.
So that is why IRFC was formed as a special purpose vehicle of Ministry of Railways to raise loans from the market, then buy those assets, and then lease those assets to Ministry of Railways for a particular period, which usually coincides with the useful life of those assets, which is generally 30 years. The average period of the asset life is 30 years.
Okay.
So all these assets are in our books, and they are owned by IRFC. You'll be surprised to know that more than 86% of the total trains that fly on Indian Railways is owned by IRFC, and they have been given on lease basis to Ministry of Railways, and after the lease period is over, that 30 years, then the ownership is passed on to Ministry of Railways at a very nominal residual value. So this is a transfer value. So this is basically the business model that IRFC has.
Okay.
So that is why we are into the leasing business. Otherwise, it could have been a simple lending business.
Okay.
So we have to acquire those assets, and then. But having said that, you also must know that all the techno-commercial aspects of all the transactions pertaining to the acquisition of these assets, be they rolling stock assets or be they project assets, that is totally looked after by Ministry of Railways. IRFC does not have any locus standi as far as the techno-commercial financial aspects of the transactions are concerned.
Okay.
We
So,
basically are facilitators by way of being the funding source. Yes, please. You were saying something.
Yeah, sir. So let's for the sake of better understanding, let's talk about some numbers. So hypothetical numbers. So let's say you acquire some asset for 100 rupees. So you take loan from the market. Okay. Let's say 100 rupee loan from the market, and you buy an asset worth 100 rupees and lease it to Indian Railways for 30 years. Okay. Now, this 100 rupee asset, you said that after 30 years will be transferred to Ministry of Railways at nominal value, or not nominal value, at let's say zero value, at hardly any value, right? So
yes.
Over 30 years, in your books, the value of the asset will become zero. Okay. So first 5 years, you will not receive any revenue from the Ministry of Railways, and you will be receiving revenues or lease rentals starting from the 6th year up to the end of 30th year, right? So suppose you borrowed the 100 rupees at 6% interest. Okay, and you said that you apply a spread of 0.4, 40 bips on it.
0.35 in case of project assets, yes.
Okay, so 0.35. So your cost, you will be charging 6.35 on this 100 purely as an interest to the railways. So how do you recover the value of the asset which has gone from 100 to 0 in the course of next 30 years? In case of a loan, you lend 100 rupees to this other entity, you charge the interest, and they start paying you the principal also along with the interest.
Okay, right? I get your point.
Yeah.
You see, what you're trying to associate is you lease rentals with the book value of the assets.
Yes. So how do you recover the book value and still make...
No. The book value of the assets has got nothing to do with the lease rentals. That you must dissociate the two. They are two different.
So I'm not looking at the accounting book value. I'm saying you invested 100 rupees in an asset and lent it to. So let me add one more thing. Suppose since you will be charging you will start the
what I will request is because this requires some discussion. You can always
just in 1 minute. In 1 minute, I will complete. Okay. We'll not drag it. Yeah. So
no, it's not. I mean, it is for the benefit of all the other.
Yes, absolutely. So it's
there's no problem. There's no problem.
Yeah.
Go ahead.
So 30-year life, 5-year moratorium. So the lease rentals will be charged over 25 years. So if you divide 100 by 25 years, 4% comes as if you are adding to 6.35, another 4% as the cost of amortization of assets. So if your lease rentals to the railways is approximately 10.35% per year, then I think it should be fine. I just wanted to confirm that you are recovering the value of the asset, which will become zero in your book.
Basically, let me clarify you.
One thing which I would like to mention here is that we recover the lease rentals in the first 15 years of these 30 years. What we call as the primary lease period, right?
Okay.
And in this, so we are recovering the entire value of the lease in the first 15 years only. In case of both, that is rolling stock as well as project assets, with the only difference that in case of project assets we have a moratorium of 5 years, and then we recover in the next 15 years. And in case of rolling stock assets, we get the lease rentals in the very first 15 years only. That is called the primary lease period.
Okay.
And in the secondary lease period, we just get a very token, lease rental of about 1 lakh per annum for all the assets put together. So we, in effect, it is basically a lease of 15 years.
Yes. Yes.
But as far as the useful life of these assets is concerned, it's 30 years. So we try to stretch the lease period by another 15 years to 30 years, so that at the time of transfer, we transfer at its nominal value. That is the only thing. So
Okay.
The entire lease rental we are recovering in the first 15 years.
But I just wanted the confirmation that you are able to recover the cost of asset, because when you are leasing, you are sitting on a depreciating asset. You have lent, right?
No, the lease rental is not based on the depreciated asset value. The lease rental is totally. That's why I said to dissociate yourself from the depreciated value. That is for the purpose of
And sir, just to supplement your this thing. See, during this moratorium period, we are capitalizing the interest. When we are not getting the rentals, we are capitalizing the interest. And
Yes.
after 5 years, when the moratorium period ends, on the capitalized value, we are working off the rentals, which is recovered for the next 15 years.
As we have said, sir, for 100 rupees, take a case of a simple interest, the 100 rupee after moratorium period will become 131, 132. And we are
Correct.
executing the agreement based on 132. The entire cost of asset and the cost of borrowing plus margin, we are recovering during the first initial 15 years. So in that way, I am recovering the entire cost of my asset, whatever be the borrowing cost plus margin. So basically, these rentals have been calculated based on this formula, and accordingly the MOR will pay during the initial 15 years based on this. These three components. They'll have a three components: the cost of the asset, the borrowing cost which we have incurred for this funding, and the margin which is payable by the MOR.
Yeah.
So
this is exactly
No,
I was
second.
trying to confirm. So
yeah,
132
what
divided by 15. So let's say you borrow 100, you buy an asset of 100, you give it to the railways, Ministry of Railways. So in 5 years moratorium period, the capitalized value of that becomes 132, let's say. So you divide that by 15. So approximately 9 rupees every year will be your cost of the asset, plus 6% cost of 6% on 132 will be your interest rate, plus 0.35 will be your spread. So all that, so 9 plus 6 plus 35,
Yes, you are right,
0.35.
sir.
So this is what you will be charging, right?
Yes.
Right.
Yeah,
So it has got nothing to do with the book value of the asset. That's what I was trying to.
I'm not talking about book value, accounting book value. I'm talking the initial acquisition cost of the asset. You have to recover it, no?
Of course,
because it's becoming zero.
acquisition cost. Yes. It is only based on
Yes.
initial acquisition cost.
Yes.
And
And capitalized
so we are recovering the entire cost.
Yeah, you have to accrue the interest because you are not charging for first 5 years, etc. So
Yeah,
that is
course.
clear. Now, second question
I'm
I
sorry
had
to
related
interrupt.
question.
I'm so sorry to interrupt, sir. Can you please join the queue for more questions? I'm really sorry.
Yeah, I mean, this
Yeah.
is, it's up to the management to decide. I'm trying to clarify the business model for the benefit of everybody. I just have one tax-related question. So, because you mentioned that there is no tax liability, so I'm assuming that since the assets are sitting on your books and you are getting the depreciation benefit, so that is the reason you are not getting.
That is the
any
reason.
tax
That is
liability.
the reason. Yes, that is the reason.
Yeah.
Yes.
Okay. Thank you, sir. I'll join the queue again.
Thank you, sir. Participants are requested to ask one question in the initial round and may join the queue for more questions. The next question comes from Fani Rajshekhar, an individual investor. Please go ahead.
Good evening, sir. My name is Rajshekhar. I am from Vijayawada. My question is, whenever the offer for sale comes in the due course of 1 year or 2 years, assume that the book value will be approximately 35 rupees. Now, the present market value where the middlemen or the brokers are trying to keep the price low, such that when the OFS comes, they can force the management to keep the price less than book value. But as the investor, every year our profits are increasing the book value where I am not getting dividends. So how can the management can assure the OFS price will not be less than the book value?
Okay. Yeah, please go ahead. DF can take
the
this question,
sir. Yeah, you to protect the investors.
No, I'm not accepting. No, I'm asking my team members to respond, please.
Basically, the present book value is 32.64 as on 30th June 22. And as per the DPAM guidelines, because you must appreciate being a NBFC, we need redeployment of our profit for further borrowings so that my gearing ratio will be in a range. So that way, as per the DPAM guidelines, we are required to pay dividend 30% of my PAT or 5% of net worth, whichever is more. So accordingly, we are paying the dividend, and whatever the surplus we are redeploying in our business. Accordingly, the book value of my per share is increasing. So these redeployment is considered because of the nature of the business and to manage our gearing ratio, so that future profitability will be enhanced as per the.
No, sir. My question is not that. My question is how the company is going to protect the investors when the book value is going to be suppose 35 rupees or 40 rupees when the OFS will come. I don't want company to give into the market less than book value and do injustice to investors who are there with the company long time without taking dividends. This is our profit which is increasing the book value. But the brokers are trying to keep the price low. So how do you protect that?
You see, the point is, we get your question. If you recall, when we went for the IPO, our offer price was almost the same level that we had for the book value. It was 26 at that point of time, if you recall, and we generally try to ensure that our book value is protected. So when we go for the OFS next time, or for new issuance of fresh issuance, it can be either OFS or it can be fresh issuance. Either of these two routes are available to us. We will definitely, ensure that our, threshold of book value is always maintained as far as when we approach the market for fresh issuance of shares. With fresh issuance of shares, we should not go beyond below book value, because, as you are rightly saying, the book value is enhanced because of the profits that we have, that we have made over these years through our efficiencies. So that should not be sacrificed. Your point is well taken, and we shall definitely see when we go for the next, OFS or fresh issuance when we approach the market next time.
Thank you, Amitabh, sir. My second question, can I ask, sir? Is it possible?
Yeah, I mean.
Only 1 minute, I'll ask. The dollar is the rupee depreciated from $70 approximately to 79.5. I know that it is a cost plus model. Is it 100% the cost of depreciation of the rupee will be passed to Indian Railways in the coming years?
Yes. That is the business model, that all the costs incidental to borrowing or lending are passed through to Government of India, including the cost of hedging in case of ECB portfolio loans. So,
thank you, sir.
Having said that, we hedge. We go for hedging. We go for partial hedging of our ECB portfolio. From time to time, we are regularly keeping a track of the markets, and whenever we are within money, we always we hedge the requisite portion of ECB that is required to safeguard the interest of Ministry of Labour.
Thank you, sir. Thank you.
Thank you, sir. The next question comes from Siddharth Gupta from Voyager Capital. Please go ahead.
Good evening, sir, and good evening to the entire management present. First of all, let me congratulate all of you for this great set of numbers as usual. Our faith in the company continues to stay despite the stock price not performing. Before I ask my question, just one small 30-second piece of advice for all analysts and investors on the call. A lot of the questions that the management's answering right now have already been answered in some of the past analyst calls done over the past few quarters about the model in much detail, and it would be a great thing if those could be explored before the call as well, so that the time of the call could be saved. Moving on to my question, so in the past quarters, the management has been moving towards amending its MOA and starting to lend to other ancillary railway-related projects. Has there been any progress in that terms? Because I've seen that there was a project signed with the Haryana state government. But are there any other possible projects in the pipeline that are coming up? Second, is there a proposal for a possible buyback that is being discussed at the management or ministry level? Because that's a possible way of rewarding shareholders. A possible way, I'm sorry, one of the concerns expressed by the investors is of an OFS or further dilution of the government stake at a price lesser than the IPO price. A possible way of doing so could be that the government, the board carries out a buyback and the government doesn't participate in the buyback, thereby diluting the stake directly.
Well, that's a bit of a hypothetical question as far as the latter part of your question is concerned, that is buyback. No such thought process has really crossed our minds or the government of India's mind as far as IRFC is concerned, number one. And number two, I mean, the first part of your question was regarding, I'm just not recollecting, if you can just, for my benefit, if you can just repeat the first part of your question. No such proposal for buyback is there as of now.
Part of my question was about ancillary railway projects. We've been amending
the
MOA to
we are in the process. Yes. Yeah, I recall now. So we are in the process, and that is under consideration of the Ministry of Railways as far as the alteration of the object clause of Articles of Association is concerned. Yes, that is under consideration.
So do we have a timeline on this as to by when? So,
no, there is no such timeline. I mean, the final call has to be the Minister of Railways call as far as the alteration is concerned, not the object clause is concerned.
Right. So,
yeah.
So just one final question. There was one recent project that was sanctioned with the Haryana state government. Are there any further projects
that is also
that are
under
in the
process.
pipeline?
Yes, that is in the pipeline. Yes, that is in the pipeline.
So I'm correct to assume that there are other state governments trying to explore their local trains and metros projects.
Of course. Why not?
IRFC.
Absolutely.
Thank you, sir. Thank you so much. Thank you.
Thank you, sir. That will be the last question for the day. I now like to hand over the floor to the management for closing comments. Please go ahead, sir.
Yes, dear investors, thank you very much for sparing a valuable time to confabulate with us, to interact with us, and we have got very good suggestions also, very good, there have been very incisive questions, and we really thank the interest that there has been evinced by the investors in IRFC, and this is your company, and we would like your company to grow, and it should be a robust growth in the coming years. And since we are dealing with Ministry of Railways, and Railways has got a very ambitious capex plan in the coming years, so the growth prospects of IRFC is closely interlinked with the growth prospects of Indian Railways, and we see a very bright future ahead for your company, IRFC. Thank you so much.
Thank you, sir. Ladies and gentlemen, this concludes your conference call for today. Thank you for your participation and for using Doorsabha's conference call service. You may all disconnect your lines now. Thank you and have a good day, everyone.
Thank you. Thank you very much.
Thank you, sir.